with our host, Alan Porter. Alan, we have an unbelievable topic today. Thanks for stopping by. And this is such an important one for sure.
Absolutely.
All right. So high income earners are realizing Wall Street can't protect them from taxes or volatility. Here's what they're switching to instead and why this works. This is a provocative, different, and directly answers that what wealthy individuals search for. Do I need a financial advisor? Why advisors failed during market crashes, and how do the rich avoid taxes? So, Alan, why are so many wealthy people becoming frustrated with traditional financial advisors?
Well, Neil, because financial advisors focus on the stock market. Understand the stock market, there's nothing guaranteed about the stock market. In fact, all it does is compound the risk in retirement, such as sequence returns risk. The number one fear in retirement is running out of money. Taxes. People say, well, I ask people, I said, why do you contribute to a 401k? Well, it's a tax deduction. I said, no, it's a tax compounder. We're in the lowest tax brackets we've been in 70 years. We have a $37 trillion deficit right now and a $217 trillion deficit for unfunded liabilities. So what do you think taxes are going to do in the future? And you go to your retirement, but they want tax-free income, they want safety, they want certainty. And most advisors never talk about fixed or fixed index annuities or cash value life insurance because they're outside the fee structure of Wall Street. So the wealthy are looking elsewhere. In fact, wealthy people don't even contribute to a 401k because they make too damn much money.
Very, very good point. What's the biggest problem with traditional stock and mutual funds only retirement plan?
It's like I said, Neil, just having stocks and mutual funds, realize this. If you get this money in a 401k, a 1% fee over a 30-year period will reduce your income by 1/3. The average fee in a 401k, according to Laptime and Forbes magazine, is 2.99%. People are going to have less than half of their money, and they get hit with taxes anywhere from 20 to over 45%. But what happens if stock market crashes? Your retirement assets could be gone overnight. High net worth individuals don't want that risk, especially close to retirement. They want guaranteed lifetime income and tax-free liquidity. And as far as I know, there's only two financial vehicles that can give you that. That's properly constructed cash value life insurance policy, whether it's index universal life or whole life, and fixed indexed annuities. And Neil, here's the thing that people have a huge problem understanding because their financial advisor, who's supposed to be fiduciary, never tell them about any of the risk in retirement, which a stock portfolio or 401k only compounds. Like I said, sequence of returns risk. Neil, this will devastate your retirement. What it is, let's say that you have $1 million in your 401k. They say a 4% distribution rate is a safe distribution rate to last for 30 years. Let's till 95. Neil, my plans go to age 120 because we're living a longer life. But let's say for 30 years. Let's say 65 and you took out that $40,000 a year. You have 10% loss in the market. Now you're down to 900,000 because you lost that 100,000. Now you're down, and then less than that because you're up to 40,000. Less than that because you pay that financial advisor a fee whether you make money or not. And Neil, what happens if 2008 happens again within the next 2 to 3 years? 38.
I was going to bring it up because remember we were doing a podcast during a couple years ago, and we were saying the market's close to crashing. I wouldn't trust this AI bubble as far as I can throw it because if they devalue AI, that's what's keeping the market the way it is. Nothing else, but ultimately AI. And I would rather invest in something. I would go build something before investing in something. Invest in something that's safe, that you're going to know you're going to have guaranteed income for life, and you know your money's going to be safe versus going ahead and risking it when the market's so volatile right now. You have no idea what could happen. A change in administration, another war. There's just the AI bubble, the real estate market, too many knowns.
Well, this is what I ask everybody out there listening to this. If you got a stock portfolio or a 401k, I want you to go ask your financial advisor, who's supposed to be a fiduciary, about the risk in retirement because sequence returns risk will devastate your retirement. The number one fear in retirement is running out of money before you run out of life. Tax risk, market risk, the list goes on and on. Just ask your financial advisor, why haven't you told me about any of these risks? Is it because you get paid a fee whether I make money or not? Are you looking out for me? You're a fiduciary. You're supposed to be looking out for me. That's a legal obligation. Well, I'm a certified financial fiduciary, but I see so many people that know absolutely, and they're 65 to 70 years of age. They got millions upon millions in their stock portfolio, and their advisors have told them nothing about the risk in retirement.
Unbelievable. What are the tax-free or tax advantage strategies wealthy individuals are switching to?
Myself, I've got 8 life insurance policies. It grows tax deferred, and it can be a tax deduction when properly structured, but it grows tax deferred. Your distributions are tax free. It does not affect the taxation of Social Security or the means testing Medicare Part B, which will be in the thousands per year. You're protected from lawsuits, liens, and judgments. I sell this product just for that portion of benefits to doctors all over the United States. It avoids probate. And if you don't know what probate is, it's a lawsuit that's initiated by you and you're going to pay for. because what the government does, they come in, they confiscate all your assets to pay for the taxes on your estate, and you're left with whatever, maybe 20 to 25%. And what's criminal about this too, attorneys get 6 to 12% of that estate for legal fees. Prince the Entertainer had no pay, no plan, no trust, no will. His family got maybe 20 to 25% of that estate.
Wow.
And then you got indexed annuities for guaranteed growth. And the other thing people don't understand, Neil, it's not about return on investment in retirement. It's about distribution of your assets. And I'll give you a perfect example. You got $1 million in that stock portfolio at a 4% distribution rate. And I've said this many times in our podcast. You didn't only need approximately $650,000 of that $1 million at age 65 to give you the same $40,000 a year guaranteed for the rest of your life, because you're guaranteed by contract never to have a loss due to a market downturn, because with insurance products, we're not tied to the market. We use indexing strategies to grow our value. But the thing is, if that indexing strategy goes up, when you annuitize the contract in certain contracts, you get an increase in income. And even if that accumulation value runs out, by contract, the insurance company have to pay you for the rest of your life. You can use it for your spouse. It's a 0.5% less, but they're insuring 2 lives. You can't do that with a stock portfolio.
No.
The older you get, the higher the distribution rate is.
Alan, I have these conversations all the time. Said, "Oh yeah, I got my retirement good. I'm good to go." They're in retirement phase, and they're not thinking about they have it still tied up in the market. You want to kick them, right? I mean, seriously, they still have it tied in the market. Yeah.
I'm not against the market, but everybody needs to be diversified. And if you're in the markets, you're not diversified. If the market goes down, everything goes down. Maybe 1 or 2 stocks if you're lucky to have those stocks. But it's unbelievable. The information that people don't know, like that's one guy said, "Alan, you made a dream of mine come true. But why don't people know this?" I said, "It's not rocket science. It ought to be taught in high school."
Right, exactly.
You know, I've got college professors with PhDs, degrees in accounting and finance that know nothing about what I talk about.
Absolutely.
It's just like one of the benefits is you become your own bank. I've been my bank for 15 years. I've never gone to the bank to borrow money for anything in the last 15 years when I learned how to do this. I just bought my wife a new car a couple months ago, and I'll give you an example. $40,000. I took $40,000 out. I'm going to pay myself back $1,000 a month. I'll probably do it faster than that. But the thing is, I'm taking it out of my cash value, Neil. And the thing about that, my cash value remains constant. It continues to compound. It's just a lien against my death benefit.
Right.
I don't even have to pay it back if I don't want to. Now it grows at 5% interest. But if I take that money and pay it to myself instead of a financial institution, think about that. If I got that from a bank and I have to pay them $1,000 a month for 40 months, that money is gone from me. It'll never compound for me.
Totally.
When I pay myself back, my cash value continues to compound. My death benefit continues to increase. And I've eliminated the effective interest cost that I pay on the money that I borrow.
How does cash value life insurance outperform traditional advisor-driven portfolios?
It grows tax deferred. It's tax-free. Principal's protected. You survive market crashes, but Neil, like I said, it eliminates or mitigates all the risk in retirement. Long-term care risk, people are not prepared for this. 70% of all Americans are going to need long-term care at some point in their life. Right now, it costs between $50,000 to $200,000 a year, goes up by 6% every year, and it can be paid for pennies on the dollar with tax-free money if you're in a life insurance policy that's properly constructed. You can't do that with a stock portfolio. When that money's gone out of a stock portfolio, it's gone. There's just no way to get it back.
How do annuities give wealthy retirees the financial security advisors fail to provide?
They give guaranteed income. And it's already proven by Harvard study, you've got to have guaranteed income in retirement to live a less stressful, happier, healthier, and longer life, because you're not worried about ups and downs of the market. Now, most people believe the 60-40 stock portfolio, 60% portfolio, 40% bonds. That's old. That's out the window. I divide mine up in a percentage, maybe it's 20 to 25% of the stock portfolio, but then you have to have guaranteed income, fixed and fixed indexed annuities, cash value life insurance. It provides so many benefits. I don't have any stocks myself. I lost too much money in 2008, but my money is guaranteed and protection. I have protection for my family in case something happens for me. Let's say that you pass. I'll give you a perfect example, Neil. This couple, they went on a retirement. They retired at 65. They're going to I call them the go, the slow go, and the no-go years. They're from 65 to 70. They want to travel, so they're out on a trip. I think a second year of their retirement. Their son is 42 years of age. He has 4 children. His wife does not work. He died of a heart attack in his driveway, washing his car. No insurance. So who do you think is going to be raising those kids? The grandparents.
Yeah.
Another one. And this is very important for people to understand. Make sure your beneficiary forms are updated every year. This guy worked at this company for over 25 years. His first wife was divorced from her like 23 years ago or something like that. He never changed the beneficiary. He got remarried. When he died, guess who got all the money? His ex-wife.
Oh my God.
I'm going to give you one more horror story. You got a couple. They've gone into retirement. They're retiring when they're 70 years of age, and now they're 73. and then one afflicted with Alzheimer's, dementia, or Parkinson's. Neil, there's a 75% chance if you're married and over 65, there's a 75% chance either you or your spouse contacting Alzheimer's, dementia, or Parkinson's. It's very sad. It will drain all your assets. It's called Medicaid spend down. The government will take all your assets and pay the care for the person that's in long-term care. And the spouse is left with one car, one house, approximately $137,000 in small subsistence loans.
Oh my gosh. Yeah. So, Alan, what's the first step for someone who wants to explore these tax-free strategies outside the traditional advisor model?
I'd like for them to call me. We do not charge a fee for my consultation. It's all about education. You can call me at 910-5110 or go to my website at strategist.com. And I have a plethora of information in there. I've got videos, I've got a YouTube channel, I've got blogs, I've got newsletters. There's a wealth of information in there that people need to know. So like I said, it's all about education. And there's a place on there where you can set an appointment with me. In fact, I've got a retirement tax calculator on there. You click on that, you put your information in there, and they're going to tell you, they're going to give you a ballpark figure on how much taxes you're going to pay in retirement on your 401k or anything else. Or you can also email me at strategicwealth0@gmail.com.
All right. That was the Strategic Wealth Strategies podcast, guys.